That is the basic confirmation or multiple time frame analysis zone and control entry model. We're going to touch on this a little bit later, more detailed using confirmation, so make sure you stay tuned for that. But this is how we use multiple time frame analysis. It is essentially aligning our higher time frame zones with our lower time frame zones to be trading in the same direction, right? So for example, our higher time frame demand comes in control. We probably don't want to be taking short trades, right? And as you can see, they worked out horribly. And why? Because our higher time frame demand forces were in control. Hopefully that makes sense. So we also, how do we qualify a supply and demand zone? So for a supply and demand zone to be tradable, it must break an opposing zone or remove a trend line. The demand zones must break a previous supply, and supply zones must break a previous demand. That opposing supply was removed by this demand, right? That qualified this demand zone because it removed supply. It's really that simple. So the second option to qualify a zone is if it removes an opposing trend line. And the zone is only valid if price breaks the trend line that was supporting the previous trend. Broke the trend line, and when you look at that, you can see a nice rally demand down below. So this is an example of a qualifying a zone with a trend line, and this is an example of qualifying a zone by removing an opposing supply zone. And these are going to be these are an odds booster as well. Just would give me more confidence in my trading decisions. The zones must be fresh. So it must be a fresh zone. Price must have not returned to the zone yet. Tested zones lose their strength and reliability. So I prefer it always to be fresh, never tested. Once it's tested, the zone pretty much becomes invalid for me, and I don't like to trade it. So just a very, very important little extra tip there.